want to watch it on your computer or whatever else, you're more than welcome. Hi, everyone. I am broadcasting simultaneously live on multiple platforms, including TikTok. So welcome to the weekly stock market update. And great to have you on here. Now, let me share the screen and get on with it straight away. Grab a pen and paper. Let me know where you're from in the chat box. And if it's your first time on one of my broadcasts as well, I'm going to go through what the recent moves mean, where the opportunities are, and what we should be considering with our portfolios. So we have got Udon Thani. Tell me where that is. John, hello. Kingston-on-Thames, Windsor, Buckinghamshire, Watford. We usually get somebody from New Zealand as well. This has been broadcast around the world. So to Americans who are up early and to New Zealanders who are up late, welcome one and all. So S&P 500, how did we do for July? Well, July, as I said, tends to be a good month, and it hasn't let us down. August, on the other hand, tends to be a bit anemic, and September, you are guaranteed pretty much, if past is anything to go by, and it's not a guarantee of the future, but it is something to go by. You may well see falls in August and September. Okay, so we know those two things can happen. By the way, Thailand, understood, fantastic. Hull. So I'm delighted. We've got people from around the world on here. You're going to find it very fruitful. Now, equities tend to perform well after Fed cut rates. Now, they haven't cut rates. They have in the UK, but they haven't in the US unless there's a recession. I'm not expecting a US recession. So when the Fed eventually gets around to cutting rates, which I think they will before the end of the year, of course, I did say it wouldn't happen in the first half of the year. I've been saying that since last year. Things were just looking too buoyant. To be honest, I think they're still buoyant, but I suspect they want to reduce them just because one or two economic indicators are now suggesting that things are more under control and they can afford to have more gunpowder in the barrel, as it were, save it for when they do need to raise rates again, as it were. Okay, so yeah, things tend to be pretty good for the markets unless there's a recession. If there's a recession, no. So that's pretty positive for the rest of the year. We're going to discuss some of these stocks. These are the most held by hedge funds. We'll do that in this webinar. And I will, as I said, I will answer your questions as well. Peter, you're normally in New Zealand. You're the one who's normally in New Zealand, but you're in lovely Thailand. Now, there's two types of investing. I wanted to give you some context to what we're going to talk about in the market update, okay? There's two types of investing. There's type A hedge funds. This is my preferred approach. They tend to be scientific in their approach. In other words, they use data, they test hypotheses, and then they make a determination based upon that. Jim Simons is of this category. Sir David Harding, who founded Winton Capital, is, you can Google these people. AHL, which Sir David Harding also founded, one of the world's largest hedge funds and most successful ones. Jim Simons, probably the most successful fund manager of all time over there. J.W. Henry owns Liverpool Football Club, also in that scientific category. Some of the largest, most successful hedge funds in history. In other words, it's an approach that I particularly like. If you want a free copy of my book, The Mind of a Trader, published by the Financial Times, or Investing Unplugged, also a free copy, then you can indeed get those for free. You just go to alpeshpatel.com/links and you will see lots of freebies there. Okay, alpeshpatel.com/links, and you'll be able to get a free copy of both the Palgrave Macmillan book of mine on investing and a free copy of The Mind of a Trader. I don't need the royalties, thank you. So, right, type B hedge funds. This is type B. These ones have more macro views. They go for stories, narratives, smart bets. Soros probably fits into this category, although from his book, Alchemy of Finance, he tries to make out as if he's more scientific in approach. He's not. And the Billions TV series is more like this. You know, it's like, hey, let's just shoot from the hip kind of thing. It's more dramatic. It's more what people think. I can't, other than Soros, I can't give you big names in that category who've done particularly well, not like in category A, which is my, as I say, preferred approach. And I've interviewed some of the world's leading traders and investors for that in my book. And I say it's completely free too. So I just wanted to tell you that because that's the approach I'm going to focus on here. Okay, I don't do this whole narrative, let's take a bet, this is going to happen or that. That's sort of for gamblers, and it's not for me. It's not my style. It's not, it's like asking me to ride a motorbike when I know how to only drive cars. Okay, it'd be pointless asking me that, and it's not something I'd really be able to help you with. So we're going to do type A, and that's my, as I say, preferred approach. I have various school prizes in maths, physics, and chemistry, so I feel a bit more comfortable with that as a geek. And it means oftentimes we will look at this. I'll tell you which stock this is, though you're more than welcome to take a guess. We will look at the statistics, we'll look at the numbers, and there's something that it's really important for you to know. In any given day, it is obvious to state that any given stock is highly unlikely to have extreme moves. Okay, that's just stating the obvious. It's highly unlikely, probabilistically, to have extreme moves. We know that. Similarly, a good company over a 250-day period should have the characteristics of a probability of being up. There's no guarantees to that, but it should be up. In between that, and this is where people who use derivatives or hedge funds blow up, or private investors blow up and panic, is in between that over a 20-day period, a 50-day period, a 100-day period, the exact same stock can have, with limited probability, but it can happen. And it's the fact that it's infrequent that it freaks people out. Sharp drops, 23% down, 26%, 17%. Low probability of a large negative return freaks people out even more because they think, oh, this isn't supposed to happen. I didn't expect this to happen. Okay. This, by the way, is one of the most successful companies in terms of providing shareholder returns in the history of the stock market over the last 1 year, 5 years, 10 years, 15 years, 20 years, 30 years, 40 years. Okay. I'll tell you a little bit later on which company it is. One of you, Peter, very sharp. Okay. So if the most successful stocks look like this, I guess it's the old Warren Buffett saying, if you can't even stomach a 26% drop, you've no business being in the stock market. There is another way of looking at that, which is, well, how do we avoid those problems? You can't avoid it outright. You might put less money in each individual stock. Well, that would limit your gains. Or on a risk mitigation, you might have other stocks which hopefully aren't as correlated. Well, sadly, when things fall, they tend to correlate to the downside. So Microsoft and Costco, for instance, will both fall at the same time, even though one is an AI company and the other one is a grocer. Now, speaking of this approach, just so I'm giving you a context in this stock market update, I really want to give you a context. First of all, I highly recommend this book. I've listened to it a couple of times on Audible, Amazon's audio service. Not a plug for either the book or the service, but I highly recommend it. It's about him, maths professor, who built a hedge fund and is worth more than, well, he's passed away recently, 23 billion. I think at his death, he was worth double that. He's good at what he does. This is one of the things he said. Success in investing is not about being right all the time. It's about minimizing losses and maximizing gains. It's what's in my Investing Unplugged book. It's what's in my Mind of a Trader book. I just wanted to mention that, just give you a bit of background rather than just saying, hey, buy this stock, sell this stock, because maybe I'm a bit too intellectual. Now, we can have projections. These are probabilities. These are projections. Again, take a guess which stock it is. These are projections for 2020, rest of 2024 and 2025 for a stock. Okay. And this is what happens with projections. They're certainly not guaranteed to be right. And they give you ranges. A 95% range means I could be anywhere from, with a 95% confidence, 136% up or down 15%. You might say, well, that's pointless. Well, what if I told you it's one of the most successful companies? If the best companies in the world are producing those kinds of ranges, then it tells you there is, as Jim Simons does, there is obviously an X factor in the market. There is something which is unquantifiable. There is something which doesn't lead to certainty. Okay. And what we're trying to do is just find the companies where these ranges give a very big upside and a very low downside risk. In the words of him, we're not trying to be right all the time because we can't. It's about minimizing losses and maximizing gains. One of the ways in which we do that is we will look at the stock price moves and look at projections and what the likely outcomes, best case and worst case might be, and then do essentially a probability distribution based upon that. Okay, now I'm going to explain some of the stocks in a moment which I like and which I don't like in just a second. Also, from Jim Simons, giving back and making positive impact on the world is a responsibility we all have. For me, that's really simple. I got this email because it was my birthday a couple of weeks ago. I got this on the 11th, just before my birthday, from one of my students. Happy birthday in advance. I've got to share this with you. I've been calculating my year-to-date returns. I'm amazed to find that I'm over 40% up so far and well over 100% over the last 18 months. Simply wouldn't have got those returns without your free teachings and great investment program data. Anyway, it's also my birthday coming up. And I was thinking, rather than buying a present for myself, I would give some money to the Widows and Orphans charity. That's the Lumbar Trust I'm co-chairman of, which is headed up by Lord Lumbar. Support present to them. Please, could you give me their details? She made a very, very generous donation indeed to the foundation. I just shared knowledge. She actually shared hard capital, and I've done fundraising for the fund before. Lord Bill Amoria, the founder of Cobra Bee, is my co-chairman on that. Anyway, I thought I would share that with you because whatever field you're in, even something as remote as investing, you can make positive impacts in the world. Now, we know it's going to be volatile from July to November, and we've already seen some of that already. We've got the data. This is from Bloomberg, Bank of America, US Equity and Quantitative Strategy Department of theirs. Okay. I'm also going to, in this talk, as I often do, about UK pension plans and how they're basically charging you too much. If you've got a pension with an employer or anybody else, please ask for the information of what they've put the money in. Now, they'll be very obscure. They'll give you a list of fund names. Then find out from those funds, what the hell is it that they've invested in? Because at the granular level, it'll be individual companies. They might have put some in bonds, but I'm saying on the whole, it'll be individual companies, and you need to get that information. That's your starting point. Then you can worry about everything else. Okay, you'll be worried about your 1% fee and forget that they might have put it into companies you don't want the money in, and you're wondering, why the hell did they put it in this? But at least get that. Now, if I'm going to put all of this into 4 quadrants, this one, this one, this one, I'm going to show you stocks in a second, like that. This is what we're really looking for, the lower risk, higher return. Okay, that's our sweet spot. They tend to be companies with few shallow drawdowns, i.e. they don't drop too often, and when they do, it's rare. They tend to have quick recoveries and frequent rises. Okay, now how are we going to find these? I'm going to show you with the data approach that I prefer. They tend to be companies with high average returns and low downside volatility. In other words, what's called a high Sortino. Upside higher than down, in other words, high alphas, good momentum, good valuation, growth, and cash flow. Now, the problem is most people will get fixated on one of these things. They'll say, oh, valuation, that's all I got from that. Alpesh, do you use a PE ratio with between 2 and 2.1657385? Okay, they will get stuck in the weeds, as it were. You need a measure of valuation, as long as, whether it's price to book, Warren Buffett's preferred one, price earnings growth, as long as it's a sensible one, it's fine. Growth is easy. Year-on-year revenue growth, year-on-year profit growth. Cash flow, I prefer cash return on capital invested, but there are other measures. The reason you're measuring each of these facets, however imperfectly, because the market is imperfect, as I've shown you, there's a big X factor of returns. At least you're discounting a lot of bad companies. And your job really is not what you might think it is. It is not to find great companies. It is actually to get rid of all the bad ones. And then what you're left with should be great companies. Okay? So your first job is not, oh, let me hunt for great companies. It's actually to get rid of all the bad stuff, because 99% of it is bad. Humans create a lot of bad companies. Well, bad for investment anyway. Now, I don't take this level of risk, but when we go to risk appetite, this is one of my students who takes far more risk than I do, takes the information I give them, and then applies it for their own risk appetite. That's fine. And you can do that with the data. So when you work out what your risk appetite is, your risk appetite might be greater than mine. Okay, it probably is. I've got a 6-year-old son. My risk appetite at the age of 53 is different to other people's. My job now is not to mess things up. It's not to sort of shoot for the moon. Before this webinar, a friend called me up and he said, so what do you do nowadays? What are your plans? I said, well, I spend a lot of time playing with my son. He said, why? Why aren't you working? I said, okay, so you want me to go and spend time with a load of random strangers raising funds around Europe instead of with my family? I said, I quite like my family. I'm not looking for a reason to run away from them. It blows people's minds. I had somebody else. I'm not kidding. This just happened. I had somebody else message me saying, oh, so you're going to be on vacation till September? I said, well, okay, if it makes you feel better, call it remote working. Okay. Anyway, my appetite will be different to other people's. The point is, I still want growth, not at these kind of crazy levels, but the point is you can take the data, remove the bad companies, and find a strategy suited to your risk appetite, which is what we're going to talk about on this webinar as well. Very important. This is information education. It is not individual financial advice, because I'm not talking to any of you individually. I don't know you individually. I'm talking in general educational terms. And that's really important that you know that. Okay. So let's do the deed. This is where we are. These are valuations. These are all still very red, because value, in other words, you're paying $29 for every future expected dollar of profit of Apple, or $27 when you buy a share of Microsoft for every future expected dollar. You're paying $27. It's a bit like buying a house. Buying a business, and the businessman says, oh, I make £100 a year in profit, or $100 in profit, and you say, okay, I'll pay 27 times that. Okay, you'd pay, and he says, oh yeah, okay, I'll take that. That's why floating your company on the stock market, which is something I plan to do eventually, is incredibly stupidly lucrative, because somebody is paying you a multiple on your present profits, even better forecasted profits, and a multiple which could be ridiculously high. You can't sell a private business for that. You might sell it for 3 or 5 times profits. You can't sell it for 27 times future profits. You're not going to, unless you're selling to an idiot. Okay. So we know valuation, given that these companies have been some of the best performers, is not the only metric in which moves stock prices. These are the cheaper ones, but we know they're less likely to grow, because growth is important. So we'll look at some of that as well. By the way, please do. We have a large number of people. I got this from Steve Bartlett. I've got a favor to ask you, friends, he says smoothly. A lot of people watch my videos but haven't followed or liked, and it helps us tremendously to reach more people thanks to algorithms. If you would please follow or subscribe, depending on which platform you're on, that would be wonderful. Thank you. Now, this is where we are with all the sectors and how the stocks are doing. Now, there's an important lesson for everybody's portfolio here. You might think, oh, it's tech. Tech's just driving everything. Well, actually, no. Financials have been doing rather well. Communication services, pretty much everything has been doing rather well, probably with the exception of basic materials, and we can go into boring reasons why that may be, or consumer staples. Now, as Jim Simon said earlier, your job is not to be right all the time. Your job is to make sure you have no big losses, so you don't have much down this side, and that your winners are bigger. Okay? Now, I would love to only have big wins like these. I wish my portfolio every single time. I'm sure Warren Buffett would wish the same, and Bill Gates, and they're billionaires who can hire supercomputers and supercomputing people, but they still don't. I can tell you what's in their portfolios. I'll show you later. But how come they don't have all the ones which have won this year? Okay, how come they can't even do it? It's because that's not what we're trying to do. What we're hoping to do is make sure we have as few big losses. That's easy. We can just have a stop loss. And the small losses will cancel out by the small gains. And so 80% of our profits will come from 20% of our stocks, which will be the outliers. Because when you've removed all the rubbish, you should hopefully, as you're sifting for gold, have 20%, which will be the big outliers. And in any given year, even last year, which was an amazing year, there's only there'll only be 1 or 2 stocks. Well, actually, last year was the exceptional year, so there were 3 or 4 or 5 stocks which were outliers. But in any given year, there might only be 20% of your stocks, of your portfolio, 4 or 5 stocks, which blow the doors off, and the rest just cancel each other out. And that's fine. That's not just my portfolio, it's Warren Buffett's and everybody else as well. Mohan, I'll answer your question a little bit later as well, and how you get control of your pension, should that be what you wish to do. Okay. Now, the things you've got to look out for. Meta, after market close yesterday, had their results, which apparently were rather good. I've not had a look. Like Warren Buffett, I don't look at the market every single day, sort of. Well, I do, but with a view to, what's happening? Read every detail. Now, Thursday, 1st of August, today, Apple, Amazon will both have their earnings reports. Of all of these companies, the ones I've highlighted in red are the really important ones. Nobody really gives a damn about any of the others. Okay, even MasterCard and T-Mobile, nobody really cares. Okay, similarly, for the rest of this week, I'm afraid Uber, who cares? Okay, the others are not market moving. right? Now, as I've said, my scientific data-driven approach sounds bigger than it is because it sounds more complicated than it needs to be, is I need to tick the value box, the growth box, the cash return on capital invested. That comes from Deutsche Bank Wealth Management. And I'll explain what that is shortly. I should say on TikTok, we've got a good number of people on there as well. So as I say, I'm broadcasting this live on multiple platforms. 6 months, I want momentum. Momentum is it's a dirty word for some reason. People think, oh no, you've got to be more intellectual than just momentum. Actually, momentum is a critical factor for stock price movements. And people say, oh no. If you don't believe me, again, ask Jim Simons, Winton Capital, AHL, because actually they weigh that more than anything. Okay, they weigh that far more than any of this. Okay. Sortino and Alpha, I need all of these to be green. And as you can see, when you go through 10,000 stocks, only about 1% will meet that criteria. So I'm throwing away 99% of companies. Well, there might be some good ones in there, Alpesh. There might be. I don't care. As long as the 1% are enough to fill my portfolio. So I avoid making any obvious mistakes. Okay. So has the past week been with the markets? This is how the past week has been. Quite a lot of green. You might say, what? Are you kidding me, Alpesh? All I've heard is headlines of how the S&P 500, and we'll talk about UK stocks in a moment, how the US stocks have fallen. Well, yeah, that's because the S&P 500 is weighted by the size of these boxes, and these boxes are based on the size of the company. So the bigger the company, the bigger the influence on the S&P. So if a few of these big red ones go down, they can make the whole index look lower, but all of these other ones have gone up. Okay, so my point being, you don't care what the market capitalization of a company is. You care about returns. And there's actually still been a lot of things to choose from. And we'll go through this. And what if, like me, you're heavily weighted in these? Then what? Well, I'll come to that as well. Okay, past year, well, ton of green. When we're investing for our pensions in my SIP, my ISA, my son's junior ISA, my wife's SIP, for our risk appetite, we're ideally looking for companies which, when we've looked at the valuation, the growth, all the Excel spreadsheet, basically, Sortino, Alpha, i.e. high average returns, low downside risk of missing it, tends to outperform when the market's going up, i.e. a tailwind, tends not to underperform when the market's falling. There's no guarantee of that in the future. But when we're looking for that, what we're looking for are things which have few shallow drops as possible, okay? And a projection forward to hit our return, that if they continue on the trend they're going on, they should at least give me 40% in a year. After all of that hard work, there's still no guarantees, but last year was amazing. 2021 was amazing. 2022, we had to hold cash pretty much the whole year. Can you see? There isn't, oh, but what's the average return? Well, the average bloody return goes everything from 80% last year, which will never happen again, exceptional year, because the market had such a massive tailwind, to 2022, where it was around 0% because you had to hold cash. But those happen once in 7 years. So can you see, given that the market gives you a lot of positive years, you are in a position to take advantage of those and make exceptional returns in a few years. And a few years, you'll make 0% because you have to hold cash. And I'll show you all of that in a second. My point is, this has been the past year. Now, I didn't invent Alphabet. I didn't invent Meta. I didn't invent Amazon. If I was so clever, how come I didn't put all my money in NVIDIA? Because I'm not so clever. Okay? It was only one of 20-odd holdings. Well, you're an idiot, Alpesh. Yeah, I know. Because I can't see into the future, and that's not what I do, and I don't have a time machine. My job is to make sure that the kind of companies I select have a limited downside risk, and if there's a tailwind, if there's a market tailwind, they should do well. In other words, if the opportunity comes about, I should be all right for 12 months. If it doesn't, I'll end up holding cash. It's a very different job to what people actually think I do. ETFs over the past month. I'm not going to, I mean, you can take a picture of this. These are exchange traded funds. I'm not going to, on this webinar, talk about these. I will at other times. Like I said, if you want to learn more about all of this, I've got a completely amazing free resources. If you go to alpeshpatel.com/links, one of the great free resources you'll see, and you'll be able to download a copy of Investing Unplugged, is my Investing Champions free program, completely free. Unlike Ray Dalio, who is the founder of the world's largest hedge funds and sells his program on Masterclass. This is completely free. There's the book, and all of this is, everything you see there is completely free. alpeshpatel.com/links. Okay, if you want to look more into it. I have a team who update those parts. Others are videos by me, which teach you everything you need to know. Some people give it to their kids so they can learn. All totally free and updated weekly. I just did an update last week. And if you look at the free Telegram channel, it's updated daily. Okay. And it's all completely free. Okay. As well. And there's a lot of free books on there. Now, ETFs you will find on there, and I talk about them there, and you can learn about them. Now let's look at year to date, how the markets have done. S&P's up 14%, NASDAQ 11%. What do you need to know? Delight, despair, delight, despair. D&D, write that down. You will always get delight and despair in the markets. 5 years out of 7, you will get more. The delights are longer than the despairs. 2 years out of 7, the despairs are longer than the delights. In other words, 5 years it goes up, 2 years it's down. Not in that order. All right. And intra-year does the same thing. This is year to date. Delight, despair, delight, despair. If you entered here, you're going to have your despair first. Your delight will come second, or here. You will also get prolonged periods of 0% growth, even in a year where you're up 14 or 11%. Simple as that. So we'll take a deeper dive into this, but I just want to give you the overview first. These are all the sectors. I do not gamble and bet at the start of the year which of these horses is going to win and how it's going to do, let alone look at the volatility of this stuff. It's all over the shop. Months of nothing and then jumps up, or months of returns and then drops. Nothing is consistent in that direction. We don't take gambles on sectors. We look at individual companies. It's a bottom-up approach, not a top-down. And you might say, well, what if you put a bit of money in each of these? Yeah, that's called spray and pray. You're not optimizing your returns. You're just praying and spraying everywhere, which you can do if you wish. It's easier to do than looking at individual stocks, but you are just spraying and praying. Okay. In terms of factors, my approach, very simple. I don't gamble on which factor is going to win. I need to tick each of these boxes. I only want companies which are growth, and a subset of those which are undervalued, and a subset of that are both growth and undervalued and generating income. Okay, so they need to tick a lot of boxes. That way, we always should be winning. We should always have companies which exhibit all of those. They won't necessarily go up straight away, because look at this. Despair, delight, despair, delight. You can be up 20% in 1 year and still be down for a prolonged period, have nothing to show for it for 6 months. Okay? And for a majority of that period, you had nothing to show for it. You had zero returns. For a majority of that period, you had no growth. The growth only came in 1-2 spurts. So you might say, oh, yeah, timing the market, not timing the market. God help us from people who say things like that. The point is very simple. If you have got quality, you will get some very poor results, even from quality, i.e. prolonged periods of nothing, prolonged periods of negative returns. People tend to be spoiled thinking they're only going to get returns which go like this. And they think, oh, I know, Alpesh, I'll just buy a bit of all of these things. That way I'll be diversified. No, still did the same. They're all highly correlated. FTSE 350, that's where we are over the past month. Those are the ones which have done the best so far. Okay, now let's talk about the S&P 500, shall we? Noel, do I care about market cap? It gives me a psychological comfort if I've got name recognition. I don't care about market cap as a requirement. I care more about volatility, and higher market cap should mean lower volatility. It doesn't necessarily. So I don't really care about market cap. I do like, think of companies as, I'm going to show you something. So I had to press a button down there to pull this thing up. Think of companies as, here we go. Okay. Now I'm going to pull that across. Let's see if we can go. Ooh, that's weird. Showing the wrong one. Anyway, showing last month's for some reason. This will get updated shortly, I am sure. What I want to show you is this. When I'm looking at those boxes, it's the first, and none of these companies meet my criteria. It is these first 6 things. Now, There are other things which correlate to better returns, like market capitalization. But there gets a point where you'd be looking at too narrow a field in all of that. So I tend not to care about that part of it so much. Okay. Whoops. Now, the other thing I want to show you with this. So where are we with the S&P 500? Well, it's had a few falls, which have caused some people to throw up, right? It is, as I've said, week in, week out, a little bit overbought like it was here, and will do what it did there. At the moment, it looks like a baby bear, which means the monthly momentum is still upwards. Okay, it could become, and there was a baby bear there as well. They happen. Could become a mama bear, which is where the MACD is falling, which could become and transition into a daddy bear where it's overbought and falls below its own moving average. Now, at the moment, all I can tell you is it's a baby bear. I could speculate and guess, but I don't want to do that, that whether it'll fall or rise, I do not know. Okay? What I do know is statistically tends to go up rather than fall. I also know historically, and this is no guarantee of the future, August and September tend to be pretty bad months. So I'd probably put my money on saying the baby is going to become a mama. Now, if you're risk-loving, you can ignore mama bears because they fall and then rise. If you're more risk-averse, you might take some money off the table. Simple as that. Okay? There's your upward trend on the NASDAQ. It's behaving similarly to the S&P. It's done this before. You've seen it there. It has drawdowns. This baby bear could become a mama. We don't know. I can give you 15 reasons why it might, 15 reasons why it won't. I don't know. Okay, I'm more risk-loving, so I've not changed any of my positions in July or August, despite some of these falls. Plus, I've been on vacation, so I couldn't care less. Okay, I'll answer some of those questions that are coming up now as well, so don't worry, I will answer them. FTSE 100, well, we've had an interest rate cut, and we're not in a recession, so maybe at long last, this might start going up. Especially if the pound, and I've not looked at it, falls against the dollar. A lot of FTSE 100 companies report their profits. Well, all of them reported in pounds, of course. And if the pound falls, but they earn in dollars, then they should see a steep rise in their profits because of accounting convention. You're just earning in dollars. The pound has fallen. You convert it into pounds. You've got more pounds to show in your P&L account. So all of a sudden, you look cheap. Price to earnings, you look cheap. So the price goes up. So I've not looked this morning what's happened as a result of interest rate cut. It's only 0.25%. The anticipation is that there'll be more to come by the end of the year. So maybe that will continue upwards. Fantastic. Top 10 S&P 500 stocks over the past month. Let's have a look at these. Let's have a look at each one of these to make sure we're not missing any opportunities. These are the ones, and these are the kind of returns they've had. 24%, 25%, 28%, 32, 42. Okay, let's have a look at some of these. Let's make sure we're not missing anything in this market update. Okay, well, there's Mohawk Industries. God knows what they do. I don't know. I don't care. However, what is interesting here is whilst on my value growth income, it's not a 7, 8, or 9, for those who are more risk-loving, given that the monthly MACD and the weekly are both rising, I should anticipate that will give you a short-term bump up. I wouldn't hold it for 12 months. I wouldn't hold it in my normal investment portfolio because it needs a 7, 8, or 9 on the value growth income, and it doesn't have that. But certainly on pure momentum alone, when the weekly and the monthly are rising from an oversold position like this, you tend to get pretty good returns, as you can see during that period what happened here. Okay, Stanley Black & Decker, again, wouldn't fit my portfolio of 7, 8, or 9 value growth income because the number's not there. However, rising monthly and weekly potentially could, over the next few weeks, maybe even 3 months, do rather well. I wouldn't hold it for 12 months, though, because it's a pure momentum play, not value growth income. Charter, not 7, 8, or 9 at the moment. However, again, looks like this is rising, could continue giving you good returns. When the monthly and the weekly are rising in tandem from an oversold position, you do tend to get some of these big moves. However, not for 12-month holding, not buy and hold forever, more intermediate investing. So not 12 months, it might be a month, it might be 2 months. And you'd probably put a tight stop loss that if it drops 5%, you're going to get the hell out of there. Now, that is a 7, 8, or 9. However, it's overbought. on the momentum. So it doesn't tick the momentum box, so it's not one for me. Might come back in the future for me. Who knows? But at the moment, it's not. CBRE, real estate. So 7, and could potentially. The only thing I don't like about it is it's a bit jagged in the prices. It's not smooth. And I like my stocks to look like Microsoft. I like them to be smooth like a baby's bottom. Okay. That is that way. And might we get that? Well, we're at a resistance. So I don't know. I just don't feel it. Biorad Laboratories, one of the big movers of the month. It's not 7, 8, or 9. However, if you're willing to take the risk, might be a short-term momentum play. You might say, are you kidding me? I mean, I don't buy it. I wouldn't put this in my pension because I don't like short-term momentum plays in my pension, I'm afraid. This, overbought, maybe not. 3M, it's not 7, 8, or 9, but maybe short-term momentum if you want that kind of risk. I don't put those in my pension, okay? Just so you know. Similarly there, looks all right to the upside over the next 2 or 3 months. This, no, doesn't admit that, and that's overbought, so no. Pool, seems to be going sideways, doesn't it? So forget it. I don't like the look of it. That's overbought. Costco will come back at some point. It's not 7, 8, or 9, so not for me. But I've given you other ones which work. Apple, I've done that for the Great Investments Program. I have told my students what my holdings in Apple are and what my holdings in Amazon are. Yes, it doesn't take a genius to know it's overbought. And the last time it was overbought, just be careful. Okay. I haven't changed my positions on these, by the way. Similar with this, overbought the last time. It doesn't take a genius. I've mentioned this a million times. It's almost an identical pattern to what happened here. Okay. So I haven't changed my positions yet, though. It's still a baby bear, and that's still a baby bear for now. But if you're more risk averse and you look at that and you think about this, you might say, I'm getting the hell out of here, cowboy. Okay. My YouTube channel does show a whole load of this in more detail, by the way. Let's look at some more of these. I don't own this. It's more a market update. That should continue in that direction. This is what I meant by the momentum plays. They might not come up on my 12-month hold in the program, like value, growth, income, 7, 8, or 9, and rising momentum. But if you just want to look at momentum alone, you want a rising weekly and monthly and a tight stop loss, and those are the returns you can get as a result. But that's almost trading your investments. That's entirely up to you. I don't do that in my pension. Trading completely different. If I do that, that's separate. Netflix, not 7, 8, or 9, and it's overbought. So if anything, not for me, I'm afraid. Probably if it falls below that, you might even want to short it. Not for me. 7, which is good, but it's overbought, so not for me. Berkshire Hathaway, overbought there. It doesn't mean it can't keep going up. It may well do. May well do. But I haven't got a hypothesis on that one, other than, as I said, my own hypothesis, which is if it isn't 7, 8, or 9, and if it's overbought, then it's not one I'd buy into. Similarly with this, not 7, 8, or 9, it's overbought, not one I'd buy into. If you did buy into it because you said, I don't care, Alpesh, just look at it. It just always moves up, Eli Lilly. It's a big cap name. I want to buy it. All these people love it. Tends to have pretty good months. That's fine. You can do that, but please be aware, and these are 2 things I want you to remember. Look at previous drawdowns, i.e. peak to trough falls, and duration to come back. So drawdown depth and duration. Are you comfortable with that? Always assume as soon as you buy it, that's what will happen. That's the first thing. And the second thing I want you to be aware of when you look at things like that is just project forward, okay, along the same trend and say, if it moved from there in the same direction of trend for 12 months, what's the return? And if the return is, say, 40%, then you're fine. If it's not, then it's probably not enough margin of error to compensate you for the kind of returns you want. Okay, so projections give you a reward. Drawdown danger, depth, and duration give you your risk. Those are the 2 things to look for. But before you look at anything, as I said, if it's a 7, 8, or 9, and it's oversold weekly and monthly momentum, both rising, then it could be quite attractive, like this one. Now, for me, that would be that would hit our program and our requirements, Charles River Laboratories. However, please don't be surprised if, as happened, it drops 27%, because it can. And you might say, oh, bugger that. I don't want something as volatile as that, especially given that it hardly ever goes up in August for whatever reason, and September more often than not falls. So no, thank you very much. Do not be glued into thinking, oh, that's a nice little line Alpesh has drawn. That's a nice little projection he's done. oh, therefore guaranteed it's just going to be like this. No, there's no guarantees. You might want to look at the news on it. I've not mentioned the news on it. What we did is we looked at value, growth, income, cash flow, Sortino, alpha. And after we did all of those, what we came up with, having looked at all of those, okay, is those numbers. That's what it's based on. Molina, 7, had a sharp recovery. That's rising. That might turn around and rise, in which case that recovery should continue and you might sit there. But I think that's a risky one because a lot of people don't like these drops. You know, these 30% drops, these 25% drops, you have to assume you're going to get the same one. If that's more than your risk appetite, and you're going to get it from the day you buy it because you're cursed and Sod's law applies, then don't buy it. Move on. People become fixated. I'm on LinkedIn as well. You can follow me there. If I don't know you, I won't connect with you on LinkedIn, but you can follow me, okay? You can follow. There's a lot more coming, so don't worry, on pensions and how to improve your pension returns. Let me know if this is your first time on here, by the way, okay? That's my LinkedIn, and I've just done there's more articles coming on there just today, actually, which I think you might like. Like I said, you can follow me on there, and the post that I've just done today are rather useful. I've done one on the Fed rate cut and how it might impact stocks. Ooh, look at me, moody. So that one's quite good. Anyway, it's on LinkedIn. And if you want to find my LinkedIn, it's alpeshpatel.com/links. By the way, I never do direct messages on TikTok. There's people who think I might reply on a comment in public, but I don't do one-to-one direct messages on TikTok. There's so many scam accounts trying to get you into crypto and onto Telegram and WhatsApp. That's not me. All right. My links are, well, you can find them here. I'm on the web and you can see me talking to you. Okay. Now, let's look at some of the mistakes that I've observed amongst investors, which can save you millions, and the stocks that I like now. Let's go into some of those. And this is really for the pensioners as well. Like I said, I think if you're going to invest, you need that scientific approach. You need to have ticked the valuation box, which could be the share price compared to profitability. You need a company which is growing, because growing companies tend to perform better than ones which aren't growing. Okay, they tend to. They're not guaranteed to, but they tend to. Okay. You want companies which are generating income. Now, if I was weighing these factors, by the way, valuation is more important than growth, which is more important than income. And valuation and momentum are probably the two most important things. Certainly the academic literature suggests it. I've written about this. I've lectured on this from my Financial Times columns as well. Is it better only hold ETFs or best to have ETFs and a mix of single stocks? Depends on your risk appetite. So I'm going to show you something. If you are more risk averse, you might just even have cash. If you take that as one extreme, you might say, Alpesh, I'm 95 years old. I've been told by the doctor I've only got 3 months to live. Therefore, I'm just going to have cash. If I give you an extreme example, okay, to give you an extreme example. This is not individual advice to you because I don't know you personally. This is from Goldman Sachs Wealth Management. Years to retirement. Now, most people think this is too conservative. I think I sit here, even though I'm 53, because I'm not too conservative. So I have 90% in stocks, 10% in cash. Now, if I was less risk loving, then I might have, say, 20% of my money in cash. I get 4.9% on a WISE account, but other banks will do similar things. I can put 20% into exchange trade funds as long as they're low volatility, because you can get high volatility ones. Okay. I'll give you an example. These are exchange traded funds, and these are their volatility numbers. I've marked in green those which are lower volatility. I don't want anything high volatility. Otherwise, why would I have a fund? Okay. So it's that. And then of the stocks you have, if you have between 20 to 40, because after 40, it's a bureaucratic nightmare and you're not removing market risk. The only way to remove market risk is not to have any stocks and be in cash. Okay. And if you want to know what Bill Gates and Warren Buffett own, you can take a picture of this on your cell phone. That's what they own. And if you notice, their top 5 holdings, after their top 5 holdings, they have less than 3% of their money, or top 6 holdings, less than 3% of their money in any other stocks. In other words, they've worked out that there are very few companies which meet their criteria. Okay, and certainly there are very few companies which meet my criteria either. Okay, so that's that. So momentum trend, and I've discussed some of the aspects of that on the MACD before. And stochastics, I want less than 20% volatility. Company size can impact that as well. So let's look at another mistake they make. They don't know about the three types of bears. There are three. A bear means a falling market, as you know. There's baby bear, where the monthly MACD is rising and you can ignore it. Mama bear, where the monthly MACD is falling, but if you're risk loving, you can ignore it. But if you had if your positions were too large, you might take some money off the table, blow on the porridge. And they could all become daddy bears, where the monthly MACD is falling from a overbought. People said, what's overbought? Well, if you look at this graph, overbought is the top 25 to 33% of it. Okay, it's falling at a sharp angle from that level across its own moving average. That suggests the momentum is so strong to the downside that you better start holding cash because daddy's coming home. Okay, so 1, you can't ignore. 2 and 3, you could ignore. 2 and 3 being these numbers on the screen. Okay, so common mistake people make. Now, for me, if there is a tailwind, it is not my genius. It is, if there is a tailwind, then we might get I didn't expect 54% over 12 months in 2020 to 2021. I did not expect that. Because if I did, I would have gone to Ladbrokes and said, I'm going to get this, make a bet with me. Okay? You will get outliers like Crocs or Generac or Costamere. They will make up for, well, wait a minute, Alpesh, you've got 208% there. How come it was only 54? Because there are a whole bunch of other stocks out of the 20 or 40 that you owned, which didn't do as well. Okay? Because you don't just pick big winners, I'm afraid, as Jim Simon said. It is the few outliers which catch the market wind. Now, it wasn't based on me thinking, oh, Crocs are advertising on Instagram their ugly shoes, they'll do well during a shutdown, or we might need more generators. Nobody's got that level of knowledge. When we're looking through 10,000 companies and going through the data on it, okay, to work out which ones tick all the boxes, okay, I'll just show you. Like this, when you're going through all of that data on here, to see which ones tick all 6 boxes. None of these do. Look at how many. These are all rejected. All rejects. Okay? It is the very few which meet. And even then, I'm not guaranteed massive returns. I'm not guaranteed. That only happened, not because of me, but because there was a market tailwind that year. Okay? Also, big mistake with pensioners, they don't have an exit plan. Generally, after 12 months, I restock the portfolio unless the individual stocks are doing so well, like an NVIDIA, that you just keep hold of it. And as a general rule, though, there's more subtleties to it than this. If it drops 25% from the high since I bought it, I'd get out. More subtleties to it than that, but I'm just giving you overall. And the other problem that private investors have is they're paying 10% in fees. They don't know they're paying 10%. This is an actual screenshot from an actual fund one of my clients showed me he was in. If you cash in after 5 years, this is what it said. You're paying £1,000 on 10,000. It's 10%. I couldn't believe it either. And there's been many articles done about how a lot of these funds are misquoting their results. Daddy bear money bet, lol. I know. BOE drop base. Yes. Do you see further rotation to the unmagnetic forward right? I don't know, Simon. I follow my process. If it happens, it happens. We'll pick it up. We'll take advantage of it. So I don't know if we'll see more rotation or not. I don't gamble on that. I'll look at my data. If the data takes me to those companies, great. If it doesn't, we'll still be fine. Okay. This is a typical problem that I want to draw to your attention. My pension provided by Legal and General. This was provided by my employer. The information was shocking. 20% growth between 2012 and 2022. Yes, because the thing you don't realize about your pension, which a lot of people don't realize, is your pension is not there to cater for your old age. It's to cater for your advisors' present school fees for their kids. Okay? The pension is there to force you to save some money. It's not meant to be there to grow. It's meant for your advisor, whether it's Legal or General or anybody else, to put their kids through private school. Right? You've made the mistake of thinking it was there to provide you growth. That's not what they're there for. They're there to just say, okay, your money at least is out of your hands and you're not going to blow it on beer and cigarettes. And they're going to give you your money back after 10 years, after they've paid for their kids' school fees. Okay, and you're going to get your 20% growth. I don't mean per annum, I mean overall. As you can tell, I absolutely hate these pension providers because they're not telling you the truth. Of course, what's the bloody alternative? Because are you really going to learn everything that I've taught you? No. 90% of the people on here or that I speak to, of course they're not. They might be better off, as Warren Buffett says, with an index tracker, S&P 500, FTSE World, FTSE 100 perhaps. Who knows? Okay. 10% will say, actually, I've sold my business. I've got a bit of time. I want the transparency of seeing all this data you're giving, and I want to manage it myself as a side job. I want to clone myself. I've been working really hard. I've earned this money, and I want to put it into the individual stocks myself and know what I own and manage it myself. That's 10% of you, and that's fine. Because even my mum isn't going to do that. She's going to say, Alpesh, what do I do? And I'm going to say, oh, just shove it in an index track and maybe a bit of Microsoft, mum. Because she hasn't got time to learn all this. Okay, but in case you thought pensions were something that they're not, they're not there for your future growth. That's a lie. Because if they were, they would be growing, wouldn't they? By definition. But you and I both know they don't grow. After the fund managers have taken all their money and sprayed and prayed everywhere and sprayed it everywhere, because their job is not to get more money out of you because they can't. You've only got a limited amount of money. Their job is to make sure you don't leave as a customer. What's the best way to make sure you don't leave as a customer? Make giving you information really difficult, make it complicated, hard to find, not something you'd enjoy doing, communicate with you once a year, maybe less, because hopefully you'll forget about it. Those are the ways in which they make sure they keep your money. And make sure you don't have any idea about any alternatives. So what choice have you got? That's their job, okay? And that way they keep your money and kids can pay 20% extra VAT on private school fees. 40% is not realistic in a year, okay? The only time it could ever possibly work, because it works for Americans, is if there's a market tailwind like 2021, 2023, there's no guarantees. 5 years out of 7, pretty good years. 2 years, we need to go into cash. High Sortino, i.e. high average return stocks with low downside falls. High alpha stocks. What do I mean by this? Let me show you an actual depiction of what I mean. And by the way, you can pull this up yourself for free. I've done it on TrendSpider. That's not free. TradingView is free. So if you wanted to, you can do it for free. All of these charts if you want. TradingView. Okay, it's completely free. So what I mean by high alpha is when there's a market tailwind, like here, the stock moves up more than the market. When the market falls, it doesn't fall as far, and we should be able to go into cash because, look, Daddy Bear, right? That's what I mean. That's what I mean by an ideal company, okay? If you said to me, what's your ideal partner look like? You might say, well, yeah, she's 6 foot, she's da-da-da-da-da. That's my ideal partner in my pension. Sadly, there aren't enough of these. Now, what this all means is you want few drawdowns, which are shallow, infrequent, don't fall as far, don't fall far, and the recoveries are quick, and they happen infrequently. And when there's a cash year like this, those years are infrequent, and they're very easy to spot as a daddy bear because the monthly MACD is overbought, falls below its own moving average. Got it? How did you know to get in? It's really simple. Value, growth, income, Sortino, alpha, I told you. And a rising monthly momentum. Simple, okay? Now, that's the simplicity. People don't like simplicity. They like to make their lives complicated and horrible and torrid. So they won't like this. Okay? I don't care. Me and Bill Gates are doing fine. He's got a few more private jets than me. Like, I've got 0. But between us, we've got a lot of private jets. Okay? We're doing fine. 50% of his money's in there. That's what I mean by high Sortino, high alpha. But there aren't enough of those. I wish there were more. Not UK, because they're just not, the numbers aren't there. You don't have enough bloody companies. I know people have a propensity to gamble. Private investors have a propensity to gamble. You've got to be able to go into cash in bad years. And I'll tell you why your pension gets absolutely messed up. Scottish Mortgage was down 50% in 2022. Ask your fund manager, ask your pension advisor, can you go into cash? They can't. Ask them, how did you perform in 2022? And they'll break into a sweat and give you a whole load of rubbish. I'll tell you what they're going to tell you. They'll say, oh, you just can't compare it on a single year. They won't tell you, we couldn't actually tell you to go into cash because then we won't get fees and we might not get you back as a client. Okay. They'll say, well, one didn't know what was going to happen. Well, I did. I said it to everybody in January of 2022. MACD's falling. I mean, don't take my word for it. Go get the books. They're free. And you'll see that I've been saying the same thing for 25 odd years. You just look at this process. I'm process driven, not guest driven. Okay. So what happens with these pension funds is for years, they'll say to you, oh, look how clever we are. Well, no, the market was going up and they never put enough money in Meta anyway. So even if the market goes up, everything's going up, they still mess it up because they don't put enough money in the ones that are going up. And then when it falls, they don't have simple rules. So you're down 70% and you just lost 6 years. Snakes and ladders, 6 years of your pension in 1 year. So here you are booking your second home in the Bahamas in your retirement and thinking you're fine. And then you just gone and lost 6 years of your pension because they cannot hold cash. Now, they will have ample people defending them because humans have a tendency to be in denial or conflicted. They have a conflict of interest. We keep it really simple. If it ticks our boxes, value, growth, income, low drawdowns, quick recoveries, etc., and we can see that it rarely does this, daddy bear, moving MACD, falls below moving average, get into cash, then we'll have those kinds of companies ideally. There aren't enough of them, but those are the ones we want. The fact that there aren't enough of them is why Warren Buffett, Bill Gates only have very few stocks or a lot of money in very few companies, because they too know there aren't more of them. Okay. But private investors like to speculate based on what the man in the pub's dog said to them about buying. It's how humans are. They have a tendency to gamble. Okay. So good years like 2021, 2023 have to make up for bad years like 2022, where we had to hold cash the whole year. Alpesh, what was your performance in 2022 if you're so clever? 0%. It was a little bit better than that, but I'm going to tell you 0. Okay. The only reason it was a little bit better than that was because we had some energy stocks in July of that year, but assume 0. That's it. But it wasn't down 65 bloody %, which is what your pension was. Just ask them, how much was your pension down in 2022? How come? Because they can't hold cash. And in sometimes the only way to remove market risk, the only defense is cash. Once in 7 years, it's always cash. Every 7 years, like clockwork. If croaky stocks, that's a Goldman Sachs measure, 30% per annum is the return on average of companies in the top 25% by cash return on capital invested. Capital invested means you buy a plant or machinery. Cash return is the return that it makes on that. Okay, companies in the top 25% of all companies by that generate 30% per annum. Not every year. Some years, like the financial crisis, nobody did that. Other years, like last year, all of the ones did more than 30%, which were in the top 25%. If hold for 12 months and then reevaluate, because I don't want you to hold for 1 minute and I don't want you to hold for 1 million years. That's where 12 months comes from. All right. If you sell anything which drops, and also it's because, Alpesh, no, I just buy and hold forever. Oh, okay. So what you're saying is you're now willing to ignore all future information and data that might come your way. Great. Very scientific. If you sell anything which drops more than 25% from the peak, it's more subtle than that, but I've given it as a generic rule. Now, what happened to us last year? Well, these are a lot of caveats. So I won't get a year like last year again. So assume this is never going to happen for me again. It was up 80%. Out of every 7 years, I only need a few years like that because it compounds at that higher rate now. Suddenly, your pension's pretty much doubled. Even if I get mediocre returns in the future, I've just doubled this year. Okay, last year. We'll see what happens by the end of this year. I don't want to count my chickens too early. But last year was a better year than I thought. I actually thought last year was going to be a down year for the market. But I don't trust my opinion. I trust the opinion of the data. And the data becomes the opinion. Okay? Well, wait a minute. If you're using this approach of looking at these things, how come by the end of the year, they're not all green? Well, why would they be by the end of the year? They're not the rules for exit. They're the rules for entry. And by the end of the year, the company should be so overvalued that they're not as attractive because they've overachieved. And also, how come there's such disparity? Well, the same reason Warren Buffett and Bill Gates' portfolio is disparate. Same approach, but how come one's down 1%, the others are up? Oh, but if you remove all the good ones, then you didn't do so well with Tapestry. Yeah, you're right. That's investing. If you remove all the good ones and the profitable ones, then all you're left with is ones which aren't good and profitable. Some people do say that. Some people should not be allowed near sharp instruments, let alone pension portfolios. These were some of the stocks. Now, obviously, NVIDIA, Meta, everybody knew about. Sterling, I had no idea what they do. Tesla, I'd obviously heard of. ServiceNow, I like it periodically. It does this. ServiceNow, like a lot of these, do this. Then it has a year of taking a breather, then another year where you want to get it. So some of these just perennially generate. Some of them every single year, others every other year. But that's what you want. Okay? Your job and mine is 10 years. If you can get 20% per annum, you won't get that as a bank account. Some years you get 0%. Let me say that again. Some years you'll get nothing. Good years, it'll make up for the bad years. You start with 100, you add 1.5 each month, and you should have 1 million by the end of 10 years. This is what it looks like. 10 years, 100 into 1 million. It won't go like this, though. It'll go like this, like that, like this, like that, like this, like that, like that, like that, like that, like that. That's how markets move. And the real gains only come at the end. That's when you get the big gains. For the first few years, and this is why people don't compound and are not patient and don't delay gratification, because for the first 4 years, you're not getting the returns. The best way to improve your pension is not to get a time machine and start earlier, because you can't get a time machine. It's not to try and put more money in. If you can, great. But most people will say, bugger me, Alpesh, I've got a life I want to live. It's actually to see if you can improve performance. Because even a small move in performance causes a big change in returns. That's what this chart shows. Okay? Movements in... And by the way, if you're thinking that's too difficult, that 15% is the sterling return on the S&P 500 over the last 10 years. Oh, well, the last 10 years might not come back again. Yeah, they might not. That's just an index tracker. It's not me. Okay? So why do I look for 20 or 40 plus in good years? Well, because there are companies which bloody generate it. So why should I say, no, thank you. I don't want the extra money. Thank you very much. It's too much. It's too much. I don't want it. Thank you. Okay, if it's there, I'll bloody take it. Okay, and the point about being better than overpaid fund managers is this. There you go. That was 2004. That's Woodford. Absolutely bloody appalling. The Financial Times ran a competition. By the way, so did Bloomberg, and I won that as well, and so did Channel 4. Show me the money, and I won that as well on one of the years. The year in which I competed. There were other years I wasn't asked to compete. I didn't win it. The year in which I competed, I won that as well. And not only that, the UK's largest private investor retail software company and monitors my selection since 2004 on the UK market because their audience is UK. And that's been doing on the UK market 18% per annum. The US, as you can imagine, will you tell me how the US has done since 2004? Okay. Yeah. Because the approaches work. 20 to 40. So please do take a more due diligent approach of looking at value growth income. Do download those books for free that I've given on alpeshpatel.com/links because it'll improve your knowledge. I'm going to answer some questions now. Okay. I've done a load of books published by the Financial Times, Wiley, Macmillan. But you can see, this is so important. Croakey, cash return on capital investment, is so important to me because this is from Goldman Sachs's chart. And I use this in my investing. I want companies in the top 25% because they generate 30%. Top 25% by cash return on capital invested because they generate 30% per annum. It was one of the Rothschilds, I think, who said that the secret to all private fortunes is private information. I don't know how private this is now because I'm making it public. It's not guaranteed. This is where people who are a bit dim-witted get confused. Look, that fell. There's not a guarantee. There's a difference between guarantee and probability, expectation based on historic performance. It's like throwing 10 heads with a coin. There are some people who get confused into thinking that means you're the world's best coin tosser. Okay. It's not guaranteed. It might be coincidence, which is perpetuating over a particularly long period of time. Just like it's a coincidence that when you throw something in the air, it keeps falling. Gravity, after all, is just a theory, isn't it? So that is a box I want to tick. Might be coincidence that those companies got 30% from 1999 to 2010. Might be coincidence, but I better tick that box. Okay. This is a typical bad portfolio somebody sent me. Too many funds. Each fund has 50 to 100 stocks in their pension. Too many companies which don't tick enough boxes, and then little wonder their performance is pretty piss poor. Okay, so I just wanted to show, if yours looks anything like that, sorry. Okay, Fundsmith were what? Down 25% in 2022? Because they can't sell their portfolio and go into cash. And they'll say to you, oh, don't worry. Look, if you just buy and hold, because it's all about time in the market, not timing the market. Look, if you just bought and hold, look, it came back. Yeah, you lost 73% of your pension. So when we were holding cash, you lost 73%. And when we got in 2023, because the MACD was rising and value growth income, and we made 203%, you made 0 across those 2 years. We made 203. So much for, time in the market, not timing the market. Big fan of your posts. Bruin Dolphin, stock spread over about 1,000 different companies, scattergun effect. Please watch for that. Ask your pension fund, why does my portfolio, and this is a little trick you can play on them, say you're going to do this. Just tell them you're going to do this. Now, it's not a perfect trick. It's a little game that I tell people to tell their pension advisors, okay? Say to them that you've decided that these will be the percentage holdings you have, okay? And put these percentages in, 50%, 9%, 7%, 7, 5. Don't do it, but I'm just saying, say you're going to do that. And when they say to you, you're an absolute insane muppet, let me give you 15 reasons why you're wrong. Then say to them, can I email Warren Buffett and tell him why he's wrong as well? Now, of course, you're not Warren Buffett. You've got different requirements, etc. My point is they will try to sell you a lot of funds because they're in the fund selling business, the commission kickback business. They're conflicted. And each fund will have 50 to 100 stocks. You'll end up with thousands of stocks. Oh, Fisher Investments, same thing. Have approached me. I want to put everything in that single fund. Of course they bloody do. Money for nothing. They've got kids. Look, there's going to be a 20% increase in school fees, up to 20% increase in school fees when VAT's added, all right, if they pass all of the school. Fisher they've got kids in private school. Ask your fund advisor, how many kids you got in private school, all right? My ambition is to turn the asset management company upside down, industry upside down. 2004, I set up a hedge fund. Hedge funds are only open to institutions, so I'm not plugging it, okay? And then we set up private equity and venture capital. I wouldn't do a retail fund because the conflict of interest is too great. I'd be interested in only making sure you never left, so I kept getting paid my fees. Well, the best way to do that is not to give you the best companies. You might think, oh, no, surely if you perform really well. No, because I can't go into cash in the years when I perform poorly. And being able to perform, go into cash, only you can do because you're a private investor. Funds can't do it. They're not allowed to charge you money for holding your cash. A bank pays you money for holding your cash. Okay, what I want to do, a bit like Uber, it's a transport company that doesn't own cars. Airbnb is a hotel company that doesn't own rooms. I want to be an asset management company that doesn't hold your assets. You hold your assets. We give you the data and the knowledge. The data and the knowledge, and don't charge you fees. Anybody can learn this. This is one woman who used to work for me. They happen to be women. I didn't do the hiring. I don't want you to think I'm sexist against men. She now runs a fund. She left university, worked for me for 2 years, and my assistant, Kirsty, worked for me for about 18 months to 2 years as well. Now as a pension solicitor. Susan, you can learn finance. Also came to me, worked for me for, I think it was about 9 months. Is now global head of communications for Wells Fargo. You can learn finance. It doesn't require a financial background. None of these had a financial background. 2 of them had English literature backgrounds. Okay. Learning how to pick stocks doesn't require a PhD. Okay. I get asked these questions. So what we decided was we wanted to get into this software business and say, well, wait a minute, why don't we avoid the conflicts of interest? Let's not give people a subscription. Let's just give them the data for life, but not charge them forever, because that'd be a conflict of interest. How do we remove the conflicts of interest? And that's what we did. And that's our ideal. I'm going to answer some questions as I do this. And when I'm picking stocks on the BBC and so on, that's what I do. Alan Fink, locked into a defined benefit scheme, which lost 23% in 2023 and gained 3.6. I know. I'm sorry, Alan. There's so much of it. Mark, I've just put up the August list. So I've not had a detailed look. I'll probably will on Friday. Well, tomorrow. Question on stock volatility. On the screener, as soon as I use files, I might have to answer that later, or if you email me, because it looks a bit detailed and I can't see it from here. How do you mitigate currency conversion exposure when you're investing in US stocks? Why would I want to mitigate currency conversion exposure? I'm looking for returns. if I'm investing, that's like saying I never buy anything abroad. Why? Holding US dollars is a diversification of my assets that I own. Got a house, got US dollars, got gold coins, got stocks, got US stocks. Great. Not worried. By the way, how's the dollar done against the pound over the last 10, 20 years? Given that I'm going to retire in 20 years, I think the direction's probably going to be the same as it is over the last 20 years, which is it's been better to hold dollars than it has pounds. So I get a double return on that. So we trialed it all on a group of people who we did them video interviews with them, and it was great. That's it. I want people to join this way. Now, 90% of you won't. 90% of you, I love you. You will do the free material. God bless you, and that's great. And I want you all to do the free stuff because there's a ton of it. alpeshpatel.com/links. Okay, there is a ton of free stuff. 99% of you. But look, all this free stuff, please do the free stuff. This free investment course, completely free. And it is incredibly detailed. Free copy of my books, Mind of a Trader. There's free daily Telegram posts, all of this. Some of you will want the private client stuff, which is what we want to float eventually on the market, want to get venture capital into and float because we think it's a different way asset management should be done. You should hold your own assets because they're yours. You should have the relationship with the stockbroker, whoever it is, and you pick the stocks, you see it, you look at the data, you tick the boxes with us looking over your shoulder and saying, yeah, that fits your risk profile, what you said. Once you've got the data and you've got the know-how, that's all it needs. And that's why I've been doing these programs. For that reason, to make it global, and we've got now clients over the world. I wanted to limit it, cap it to 250, but actually I'm looking at about 300 now before I decide the structure going forward. There is no ongoing fees. Is what I love about it as well. Anyway, if you would like to be part of that, beyond the free stuff, you're more than welcome. And it's hand-holding for life from me as well. For the first 300, it's hand-holding for life. It's a program. It's not a course. It's a program in the sense that you've got data, software that we give you, and then I look over your shoulder and tell you what you should do. Elizabeth, I had to laugh when you mentioned you had assistants do well who started with English literature. My daughter's about to start an English degree and is exploring what she wants to do. A-level math does have A-level math. Well, there you go. So if you look at, say, Naomi, she started with English. I think it was English language. Might have been literature at degree level, and now is a fund manager. So, you know, I used to think, oh, no, you got to do maths. You got, no, you don't. Should send a. Do feel free. I have a whole load of help that I give students, Elizabeth. Let me show you the help I give students. If you go to the bottom here, you will see internship work experience remotely, completely free to students as well. And I've done videos. Oh, you should look at my TEDx talks. If you also go, why aren't you rich? The Mindset of Wealth. Such as I did 2 TEDx talks. There is career advice. So yes, do where I've done interviews with some leading speakers. I don't know where it's gone. It's there somewhere on my YouTube channel who are from banks. So her doors are very much open, even though you might think, oh, English literature, what's she going to do? You know, the finance is not closed. I was surprised. I didn't know until I saw my staff do it, 2 of them do it. And Kirsty went on to become a pensions lawyer, and she also did English. She studied with Naomi. Okay. So that's my ambition. It's to get, you know, if somebody's got a 500K SIP or ISA, a 20% return is 100K return for them. 20% return is 100K return for them. And that's the job. And that education, from whether it's been my TV appearances, my Bloomberg TV show, my Financial Times columns, all the books, that's where it's been going towards, is making sure people have it and have got the information and the education on it. You go to here if you want to be part of the getting the data for free. It's a one-off fee for life. Okay, it's one-off for life. That's it. I'm going to answer some more questions. The free stuff has been absolutely instrumental for me. I've gained a lot more confidence. I'm delighted, Gavin. Insights, select my own stocks. Good. No, I'm delighted, Peter. How much are the UK brokers charging? In New Zealand, we get a max $5 per trade. I think with the UK brokers, have a look at, say, It's not just UK ones. Have a look at the usual ones, Free Trade, HL, they're more expensive, interactive brokers and interactive investors as well. Have a look at all of those because they will all have charging rates which change all the time. So you can get some cheaper ones. I think Free Trade might be the cheapest, but it might be that interactive brokers are as well. What you want to do in a SIP is not keep, when you sell a stock, not have it converted to sterling and then back to US dollars. Interactive, avoid that, I believe, but check. And so, yeah. And the other thing is, in an ISA, you can't hold dollars, so that always gets converted back and forth. But if you're holding for 12 months and you make a 20-30% return in a good year, what do you care? Okay, that they converted it and took a percentage off you. They do. It's a pain that they do that. It's annoying. Any other questions? If there's any questions, please let me know. You who are watching this are the closest there is, DIY, to what I think are all the boxes you need ticked. You need all these boxes ticked. Okay, maybe, I spelt research wrong. Maybe not so much research reports, they don't matter. But the IFA, as you can see, are the worst. They're the furthest away, and the fund managers are the furthest away. They're so conflicted because they don't tell you they can't ever go into cash. So they don't tell you, and it's a great little game they've got because it means 5 years out of 7 they can market to you. In the 7th year, when they lose 6 years of your pension, they can say, oh, well, that was just an aberration. Just ignore that. Okay, and when they give you 0% over 2 years and you could have had the 200-odd%, and you go through the headache and the heartache of these steep drops, then what? And this is an extreme example. I'm giving Meta as an extreme example because it happened. But it wasn't the only one. There were others. Okay, and we're talking big companies, let alone what happened with smaller ones. Okay, you will get periods where, okay, hang on, Alpesh, that's 0%. And they will keep plugging away at that. Let's look at, and in a down year, there's more correlation to the downside. So other things will move down at the same time. There, 2023. And you might say, oh, no, that's just tech, Alpesh. Okay, well, look, I like Costco, okay? Generally, I don't own any of it at the moment. But there'll be periods when you're just better off having cash holdings on it. That's 20%. Now, every other year, you can see through that. It's fine. But basically, if that's falling, I don't want to be in it. Okay. And when it's rising, I do, especially if the weekly is also rising at the same time, then that usually is a pretty good entry point. And boom. As long as, value growth income is there as well. And that's Costco. So I'm not just talking, it's the Magnificent Seven. No, there are others. Eli Lilly, Novo Nordisk can be good to go to. Costco can be good to go to. ServiceNow can, not perennially, in and out over a year. Not trading, not timing. You're only looking to make sure it doesn't fall below the MACD and it ticks value growth income boxes. Those are the things. And even if, let's say, all of a sudden the markets are going to never deliver anything beyond a mediocre return. Well, at least I had last year. And the pension shoots up. And okay, you've got that. And your biggest headache you've got continues to be your tax liabilities. Oh, and by the way, the government, as I said before, is going to go for pensions because there's just too many trillions in pensions that they cannot not touch. So they're coming for pensioners. And all I can say is save more, improve performance more, because they're coming for it. Because they do it in Eastern Europe, they do it in Latin America. Why would they not do it in Britain? One more, if I may, regarding PEG. Am I right in thinking this is just purely a single measure and you should look at the broader scope? PEG's good. You ideally want below 1, but even below 1.1 should be fine. United Health is on my radar, but its PEG is higher than 1. Oh, don't worry about it if it's higher than 1. I mean, I don't look at PEG as it's not a must-have. It's a nice-to-have. I like the growth. Exactly, because growth can outscore value. Okay? To have profitable, if I have a portfolio of 50K, can invest 3K per month, is it still invest during your program? Do you have any tools for expected ROI? That might be too small, only because you'd be giving such a large percentage of your portfolio to make the one-off. I mean, we have an installment program, but I think that might be a bit small. We do have one person who's David, he's actually a Marine. No, he's a commander in the Royal Marines who has a similar sized portfolio, but it might be too small for you, because you might think, wait a minute, it's too much going into the program from this, and therefore maybe build it up over a period of time. It's not what you probably expected me to say. Probably expect me to say, nah, don't worry, that'll be fine. We'll look after you. I'd rather you had peace of mind. And sleep on it when it grows a bit more, learn from the free material. When it grows a bit more, then you might think, oh, this is now just a small. I mean, most people who come onto it, well, one group will say it's a no-brainer because they've got over 100K and they go, this is a no-brainer. You know, even if you only deliver an extra X percent, I'm still going to be up, Alpesh. And that's usually the calculation you're looking for from somebody who says, well, actually, even if over the next 5 years I only get an extra 5% per annum, that still is significantly more. Forget the odd year where we got the opportunity to make 40% up or 20%. If I get another 2023, I'll be very lucky and very happy. I'll be lucky because I didn't make the market move. So it really should be where it's more a no-brainer for somebody. But please have a look at the free material. It really is, if I may say so myself, my best work. And there's a lot of it that I've just given away. I mean, I could have charged for courses. Ray Dalio charges for his masterclass program, but I'd rather not. I'd rather give for 99% of you, this is all free. And I'm happy to do that. Any other questions? Finley. Hi, Alpesh. I'm almost 20. When do you think would be a good time to join your program? Well, as I say, when it's a no-brainer for you, I guess, in a way. I mean, feel free to reach out and say, but the free material now, just do the free material now, I would have thought. Alan, think if anyone has succeeded in getting out of a DB scheme into a SIP, please let me know, as that's Alpesh's fees. I know. Alan, I'm not a specialist on defined benefit and all of that, and you'd need to speak to a specialist about how to move into a SIP. I'm sure people have. There's a government pensions advice service. Maybe speak to them. Actually, it's a rather brilliant one, actually. What's it called? I've got it because I've been dealing with my parents' materials. Oh, here it is. Yeah, so HM Government. Where are we? Can you see that? HM Government. And it's Money Helper Pensions. There's a phone number, okay, and it's a government one. So please make sure it's the government.gov website you go to. And they've got a number. Book your free pension-wise appointment from Money Helper. That's from the government, okay? And I'll give you the number. It's 0800 138 3944. 0800 138 3944. But please check that on the internet and cross-reference it, because I'm a bloke on the internet and I want you always to check and cross-refer. But that's a government website thing. Your pension, your choice is Money Helper, it's called. And believe it or not, I trust the government. There you go. There's the numbers. So I'd speak to them about those kinds of things. Because like I said, it's not conflicted. They've even got a WhatsApp, but please be careful with WhatsApps and things. But yeah, call them up, and they've got lots of free guides on these things. So I would look at that, and the material is actually, the way I got into investing was government literature. I was 12 years old. We used to live opposite a post office. I used to buy those, I used to pick up those government gilt flyers they used to have in post offices, if anybody remembers what post offices are. And that's how I learned, because that literature is so easy to understand. A 12-year-old can understand it. Why? Because A, it's the government, and B, it's for people they thought for elderly people, but I was 12. And so I bought government gilts and I got addicted. 212 will be introducing a SIP. I suspect this will be very competitive. You may well be right. I've not heard negative things about 212, so I assume they will continue being good. So, yeah, fair enough. Okay. I think that's everything for those who've signed up. Thank you very much. I will send you an email shortly. Please be patient. You will get a very nice email, and then we'll onboard. We'll have our calls. you have unlimited calls with me for life, as well as part and parcel of that, I should say. Okay. And it's all here. It's all alpeshpatel.com/shares. Okay. And I sort of explain, most people only want two things. They want the data and they want access to me, I've discovered. Everything else they don't care about. They don't care about the education. They don't care about anything else. My job is to put myself in a position where if there's opportunities in the market, we take advantage of them. We're not trading those markets. We are investing for 12 months. And I make sure people are well informed because they've got the transparency of having all the data and they've got the power of the knowledge. They don't tend to look through all of this educational material, even though it's there. So it's just there for them to read. Like my book, I send them copies of my 2 most recent investment books. They don't tend to read that. They just want to have the tutorials with me, one-to-one tutorials. That's the way it works. Thank you, Simon. Thank you very much. Oh, I appreciate it. Thank you, Peter, as well. US governments are having a strong uptick. How does this affect US equities? Chris, that's a whole article. Simple question, one sentence. It's a whole article. I'll try and do an article on that, on government bonds and US equities, and what previously used to be an inverse correlation between them, but actually now has been often as time moving in tandem, and that relationship has broken down. It's the kind of question I get at university, but I'll try and answer it. So when I provide all of this, it's not really this what they want. They want the data, which I sometimes refer to as the software, the data, and they want the access to me. I do give them, wherever I can, the free software whenever it's free, for looking at news or charts and stuff. But most people don't need to or want to do that. They just want the summaries, and they want to know, well, how does it work? And they don't need to learn all of this, because actually after the first hour, they're up to speed. It's like I'm your driving instructor. My job is to be your driving instructor, to teach you how to drive. Okay. Then that's it. Then you're proficient at driving. You don't need to keep coming back to your driving instructor. That's really the goal. Over there. Let me go in reverse. Okay. I don't think there's any more questions. Thank you all very much. Oh, Finlay, thank you. I'm delighted. Thank you for all the nice messages. Thanks, everyone. And thanks, everyone, on TikTok. I have lots and lots of people on TikTok who have been on for ages. So I'm going to see if... Ooh, I'll send them that. Going to turn that off as well. Thank you, all you TikTokers. There we go. We had 1,900 viewers on TikTok. Can you believe it? 1,900 across the webinar. Wow. Fantastic. Okay, everyone. Thank you all very much. And everyone who's signed up, I will speak to you shortly. Thanks all. Ooh, I meant to do this. Thanks all. See ya.